And welcome. Thank you very much for joining us on this webinar on building shareholder value during the coronavirus crisis. The format for today is I will do an introduction and a market update, and then spend a little time talking about what buyers want. And then I'm going to hand over to Paul Winterflood, who's a fellow director in the media corporate finance team, and he's going to talk about building market share in uncertainty. And then I'm absolutely delighted that we're being joined by Barry Bryan, who was at Creston, which is a marketing group where for 12 years as both COO and CEO, he led on acquisitions, and now he is Group CEO and founder at Strat7. Strat7 is a group which brings together a partnership of data, insight analytics and strategy specialists. The business is PE backed and has made 3 acquisitions already, and is planning to continue to be an acquisitive business. So no one better place to talk about what the buyer's view is than Barry. We will ask to hold for questions at the end, but questions can be posted as you go in the Q&A function. And after the webinar, a recording will be available, and we will also circulate the slides and the Q&A. So just a quick update on what we're seeing in the market in our quarterly report on M&A in the marketing and media sector, which is due to come out in the next couple of weeks. In our first quarter M&A review of the sector, we anticipated that the first half activity would be significantly down, and unfortunately that's proved true. It's hard to do deals in the current situation, and particularly so for creative businesses where chemistry and culture is so important. Digital marketing continues to perform very strongly. Digital marketing represented about 39% of deals in the marketing services sector, and we expect this to continue with strong interest from acquirers in agencies that enable clients to pursue digital first strategies. We also see strong demand for companies that have been focused on their existing, been just as focused on their existing business as the rest of us. And businesses with performance-based marketing propositions. The global networks have pressed pause on UK M&A activity. I think they've been sorting their own houses out, and there have been no UK deals involving the networks in this quarter. Consultants are still in the market. So whilst the global networks appear to have pressed the pause button, some of the consulting firms have remained very active. EY bought Swedish design and innovation firm Doberman, and PA Consulting announced its acquisition of San Francisco headquartered brand strategy and product design business Astro Studios. Possibly the main reason for that acquisition was it gives PA a new West Coast presence. Private equity appetite absolutely remains strong. PE-backed investments accounted for just about half of Q2 deals. And we know from the buyers that we talk to that PEs are keen to support them on acquisitions. Global holding companies may have paused, but the keen buyers that we're talking to are primarily independent agency groups with strong balance sheets. And as I said, PE-backed businesses with deep pockets, keen to support their portfolio companies in acquisition. So I think we expect M&A activity to remain low for quarter 3, but the signs are that the market is starting to look like it might pick up a little bit in quarter 4. We also expect to see more accelerated M&A or rescue deals as the government's support packages start to fall away over the next 2 to 3 months. So that's just a quick update of what we're seeing in the marketplace. Now, moving on to what we're talking about this morning. When the crisis hit most of the marketing services clients that we have, they went into survival mode, cutting costs, preserving cash and fundraising. Everyone was scrambling to take advantage of the government support, and a huge number were furloughing staff, looking at shorter working weeks, and pay reductions. However, regardless of how severely businesses have been affected, it's vital to be thinking about how you reset your business for growth. This is the new normal for a little while, we suspect, but we also know that change often presents opportunities. In a recent survey we carried out amongst our marketing services clients, 3/4 thought the current environment provided their business with opportunities. So clearly there is significant optimism out there. Some of these opportunities were to make acquisitions, some for increased sales, but over half for rationalisation of certain aspects of the business, sometimes admitting that this was a good opportunity to take difficult decisions with regards to resource they should perhaps have taken already. What I do think is how leaders respond will determine where you land. So don't procrastinate, look at the changes required, prioritise your time, have a written plan. Don't just survive, aim to thrive as we come out of this survival phase through recovery and into growth. So moving on to really what then we might be aiming to go for if we're looking for an eventual sale, and what we ought to be planning to deliver as we come out through this hopefully growth phase. What buyers want is actually what any owner of an agency would like: a successful growing business with a great future. We've worked with agencies for over 30 years. We carry out a lot of research, and some of the most powerful research we carried out was a couple of years ago called Survivor to Thriver, which gives the top 10 strategies used by Thriver agencies. And we looked at agencies that hadn't been faring terribly well in previous surveys. We do a review of the financial performance of marketing services agencies in the UK, but had turned the business around and were absolutely shooting the lights out. And the top 10 things that these guys did were: don't procrastinate. They took the tough decisions. They often had external support, a non-exec director or someone like us going along regularly, challenging their decisions and keeping them taking the tough decisions. They chose their clients carefully, choosing the company you want to keep, choosing the clients with which you'd like your business to be associated is really important. It sets the tone, it impacts bottom line, it can impact staff morale, it can impact profits. It's a really important thing, and they all did this. Be clear on your proposition. Be famous for doing something well. Be able to say, we're brilliant at doing this, but we don't do that. Don't be a jack of all trades. That was certainly one of the things that came out of the research. The best agencies look for talent. They don't just fill vacancies. They often had a waiting bench, if you like, of talent that they were talking to that they could bring in when the opportunity arose. Staff, they engaged their people authentically. They were very open with them. They were very honest with them. They often did regular staff surveys and engagement surveys. And in point of fact, our HR consultancy is doing a lot more of these at the moment because people are clearly seeing this as an area they really need to focus on during remote working and as we come out of this. Focus on strategic work. It's more interesting, it's more profitable, and it binds you more closely to your clients. So be a business partner to your clients, don't be a servant to your clients. If clients don't work financially, then look at the long tail of scrappy clients and be ruthless. Either put the fees up so that they do work, or very nicely and kindly fire them. You all know that there are clients out there that are time wasters, and it's best to get rid of them and free up that resource to do something more positive and valuable. Take time to really think about the business with your clients' businesses. What do your clients want? What should you be structuring your business in order to provide to them? It's absolutely crucial to get this right. And don't get complacent. It's easy, but they again used external support in order to make sure that they didn't get complacent. They remained challenging themselves. And all of these businesses generated compound annual growth rates well up in the 20% as a result of taking these 10 significant focused actions. So how does that then roll on into what makes an attractive purchase acquisition? Well, we run sessions looking at exactly this, and our experience tells us that when buyers are looking at a target acquisition, they're concerned to see the client mix. They don't want an overdependence on any one client or a difficult sector. They like to see income security and quality, so you can see your income going forwards in years, not weeks. Value proposition and brand needs to be strong and needs to be something that's relevant to your clients and to their clients. A good solid sales and marketing process so that they can see that the business will indeed continue to generate growth. Owner reliance, not too much reliance on the owners. Anybody who sees that there's one founder who has all the client relationships who wants to sell the business is going to be much more unnerved than if they see that the founder has put in a senior management team, engaged them in running the business, and that they have the client relationships, and there's a nice spread across the agency of all those relationships. And talking of the management team, you want to see a management team that's in place, are in practice at running the business, and who have some skin in the game. Again, if you've got a 100% owner who's suggesting that the management team is going to be there delivering a 3 or 4 year earnout, then any buyer is going to look askance at how motivated they're going to be during that earnout, would much rather be seeing them with some share of that earnout as the business goes forward, and more than just a sort of notional 1% each, a proper significant share. Management information. Time and again, we find that one of the things that can derail an acquisition process is that the selling client doesn't have the in-house resource to be able to produce suitable management information in a suitable time frame. So being able to have management information that can tell the buyer what's going on ought to be something you have anyhow, because it should be management information that can tell you what's going on with key performance indicators, and looking at more than just historic financial performance, also looking at lead indicators as well, like new business pipeline and similar. They want to see a smart strategy and governance. They want to see that the owners have a direction for the business, and that when they're looking for an acquirer, that they are considering how the acquirer can enhance their business and deal with some of the strategic challenges they've identified going forward. And they want to see profit performance, because whichever way you look at it, when you sell a business, it's valued on the basis of a profit. It's profit times a multiple. And I'll come on to talk a little bit more about that in the moment. But having a pretty solid and consistent profit performance which grows over time is also very attractive for a buyer, because they can see how they can leverage that once the business is part of their group. So if we just, so we'll move on to look at the results of some of the workshops that we run. So we run something called a Cares 360, which is a half-day workshop which looks at all the drivers for success of an agency across all the things I've been talking about so far. And one of the things I should say is a lot of agencies think they're doing pretty well. Very few agencies score more than 50% across the board, actually, when they really probe themselves in this workshop in order to assess how well they're doing. And this workshop is designed to understand an organisation's current state vis-a-vis 36 critical success factors and the key drivers of enterprise value. And it scores the key drivers of enterprise value, and the agency effectively marks itself out of 10 and is then challenged on that, and assesses the extent to which the organisation is set up for success and proactively identifies the gaps and prioritises what needs to be done. The biggest gaps, I can tell you, often relate to the biggest drivers of enterprise value, yet most leaders are unaware or not managing the biggest improvement opportunities. And because they're not proactively asking themselves the right questions, they're missing some of the things they should focus on. And it's key, I think, to know exactly what the main things that are going to move the dial on your business actually are. So moving on, proactive prioritization. proactive prioritization and focus can substantially drive increases in performance, profitability, and enterprise value. The top performers expend 80% of the time on resource on the 20%, the vital few things that will generate 80% of the improvement. And I'm sure everybody's heard of the 80-20-80 rule. But the question is, do you really know what your 20% is? Do you know how effectively to manage that 20%? And are you focused on delivering that in order to drive the value and get back to the things that buyers look for when we're selling a business? So if I just go to the next slide. So here's just an illustration of that enterprise value optimization journey. So first off, you establish where you are at the moment. What is the current state of the business? What are the 20% of the most important, what are the 20% most important things that are really going to make a difference to your business that you need to focus on? And you start focusing on them. And so the looking at the journey to exit, having established the current state, you don't procrastinate, and if you don't prioritize, if you procrastinate and you don't prioritize, you end up going down the grey line. But if you do prioritize and really shift the levers, you can, the trajectory is up the pink line. And this is because of two things. One is that the profit improves, but also the multiple improves. So if you get all the things right that we've been talking about so far, it really does enhance the multiple of the business because it makes it a far more attractive business to buy. So there's kind of a double bubble, because not only does the profit get bigger, but the multiple applied to it ought also to improve. And then as we move through from A to B, you're working on the 20%, business development effectiveness, improving lead generation, improving conversion rates, and profit per sale is one of the key things that often agencies struggle with, and it's one of the key things to get right. Incentivizing key employees and improving employee engagement and having all the team pointing at the same strategic direction is another massive benefit that comes from having this clearly articulated and prioritized strategic direction. And operational efficiency, improving job profitability, because you're working with the right clients and delivering them the right service, does really deliver a significant improvement in profitability as well as therefore an uplift in value. So having done all of this, we end up with an improved set of traffic lights against what makes this an attractive business to buy. So the client mix is probably better because by generating lots of revenue in the pipeline, you can pick and choose your clients more carefully. You can dilute dependence on a client, and you can be more robust with your pricing. You can see further into the distance because you've got a longer business pipeline. So income security and profitability include. You're clear about your value proposition because you've worked on that. Again, if you've had owner reliance and you've diversified to a senior management team, again, that's a much better matrix for the next two. Management information, you should be looking at the key performance indicators relevant for your business, as I said before, and have developed a smart strategy and governance, and the profit performance, as I said, is a lot better. And so you can see that actually by getting all those things right, not only is the profit higher, but also, this is an illustrative multiple, the multiple is higher. So you get an exponential increase in value from where you were to where you are now if you can actively manage those 20%. And last slide from me, it does really leave you in a great position to sell, because you see the best position is the pink line, the position of strength. You've got competing bidders, some or all of the buyers opposite would be interested in a business like this. No price chip through due diligence or negotiation, because actually there's nothing to price chip against your business because it's solid and it's robust. And the strength that you can walk away and go to another buyer if any potential buyer does start behaving badly, because you've got plenty of interest, because you've got plenty of options as a result of having got all those aspects of the business right. So that's it for me. I'm going to hand over to Paul now, who's going to talk about business development, which I certainly think is absolutely key to building value in the business. Paul, over to you.
Thanks, Mandy. Afternoon, everyone. So yes, in this next section, I'm going to run through a couple of specific things that the thriving and most successful agencies will be doing at the current time to build value and in particular to increase their market share. Most successful leaders will always be looking to build shareholder value and will be looking at the current situation, situation of turbulence, and thinking now's the perfect time to try and grow market share. So when we do come out the other side, we will have grown significantly. So we're going to look at a couple of areas that you can be working on at the moment. So firstly, just going back into the overview of the key areas that drive business, drive businesses. I think when buyers are looking at businesses, particularly when we're selling agencies, probably the three most important ones when it comes to selling a business are the people, the finance, and business development. The other areas are very, very important, but they very much get you to the position to be able to sell. Business development, I'd say, is probably the most key one there, and it's key both before the exit event and after the exit event, because you need to be able to justify to a buyer that you can do it after you've been sold. So that's the one area I'm going to focus on now. Is that is a key area you can really make a difference on to improve the fortunes of your agency. So just going back slightly to Survivor to Thriver. Of those top 10 features that Mandy identified and talked through earlier, over half of them were related to business development, and that very much demonstrates what a key element to success BD is. Thriving agencies will be exceptionally strong at this element of business, and even more importantly, at the current time, business development is really key to be getting right. When your business is vulnerable, you need to keep business coming through the door, and the environment is likely to be far more competitive than normal. I'm sure that's what you're saying to the brands that you work with, and equally, it's just as relevant to you as a business. However, when we're actually working with agencies, when we're doing the diagnostic workshops, whether that's the 360 or whether that's a steady, ready, sell exercise, we do find that a lot of agencies do perform particularly badly on business development. So on this next slide, what we're doing here is just going through the BD process in terms of how we assess it. So I'm sure you're all very familiar with the process. We split it down into six key steps. And what we've done is we've aligned some of the common business problems you may be facing with each of the key steps. So origination is what we're going to focus on today, and that's about generating more new business opportunities. And I think one of the quirks of the industry is that we find that even though the most successful agencies that we speak to, and in Survivor to Thriver that prove that, BD is critical to success, when we actually take agencies through a structured workshop, we find they don't score as well as they expect to, and say the same issues keep coming up. So first of all, target market. So I think what most clients think they know what their target markets are. Not many businesses assess it and continually assess it in a structured way. So this is one particular tool that we use. When we work with clients, we take them through this matrix to help them assess the relative attractiveness of the market they're operating in, but also compare that to their own strengths and competitive positions. So firstly, market effectiveness, market attractiveness. The factors we're assessing here are the market size and the growth potential. Now that may well have changed in the new normal. So when the situation changes, it's even more important to do an exercise like this to really check that that your target market is still an attractive one. The other areas to consider are the industry profit margins, competitive intensity, It's always very important to know what your competitors are up to and how much competition there is out there. And finally, barriers to entry and exit. How much specialist knowledge is required, for instance. Next, we also map your particular competitive position. So what your relative market share is, what your brand strength is, what existing client relationships you have, if you have any specific market knowledge and USPs. And what you do is you map this for each of your products and offerings. And each box has a recommended strategy, and this helps you to decide which markets you should be focusing on to making sure that you are maximizing your potential and doing it in a cost-effective manner. I think one thing that we notice is that it's amazing how many businesses operate in a market because they've always done so. They're never refreshing this. They're just doing it on an internal looking basis. So just onto a quick case study. One agency that we have worked with previously had been struggling with their performance, and in particular new business generation. They've been investing loads of money into their business development effort, but were targeting clients in a sector that wasn't particularly attractive because they hadn't done this exercise, nor was it particularly profitable, or nor was the market growing. They were targeting it purely because they'd always worked in that sector, but consequently the conversion rates were very low. What they hadn't done was step back and question whether this was the most effective use of their limited BD resource. So what we did was we undertook a small number of voice of the customer exercises with their clients, which is a very cost-effective way to find out what your target market thinks of you, so you can assess it and make changes as necessary. And what we found was when we spoke to their clients was that they confirmed what we suspected, and that was that their value proposition in this particular market segment was weak, and that explained the low conversion rates. So we went back to this matrix and mapped out again their various products and markets, and we identified a new market for them to focus on. And so they've now started targeting this sector actively. Their conversion rates have improved and their margins have improved because their BD processes further down the sales and marketing process are a lot more effective because of this exercise. So that takes us nicely into value proposition. And I think this slide, what this slide does it identifies the problem and sums up the problem that particular client experienced. And this is a study done by Bain a few years ago, and this is very much consistent with our own findings when we run workshops with clients, and that's that companies think that they're performing a lot better than they actually are in a competitive environment. I think a good way to think about this is how many times do you hear when you ask the pitch feedback that you were a close second in a pitch? I think it's quite common in all industries that you'll only really get the truth on how you actually performed in a pitch and what the real underlying reasons for why you came second when a third party actually starts asking the questions and probing about value proposition. So it does mean that people are using ineffective data to assess whether the market and their value proposition are right to actually build value. So actually critically analysing and improving your value proposition using third-party data points is very important. It's one of the most effective ways that you can improve both the sales performance and margins. So is your value proposition strong enough? So that's the second area I'm going to focus on. Again, most businesses think they have a strong value proposition, but if conversion rates are less than 75%, then that suggests there could be room for improvement. I think if conversion rates are less than 50%, then there's almost certainly a problem And a lot of agencies we speak to, there's a general acceptance that around 25% is okay and acceptable, which, when you consider the amount of time it costs to pitch for business and the amount of money spent on business development, it really is not. It really isn't acceptable. It really isn't a. It's really not a position of strength, and so there's definite room for improvements there. So for clients looking to identify where their weaknesses are, there's a structured 5-step process we use for critically assessing value proposition. And when we do this with clients, we ask them to self-score before and after, and usually we find that the score goes down quite significantly once they've analysed the key elements of value proposition critically. And taking it back to the voice of the customer. Voice of the customer is again a really useful tool for this. And if a third party is asking one of your clients or one of your lost prospects why you lost the pitch, then typically they might be able to identify weaknesses in your value proposition and explain why they bought from one of your competitors. Also, they're typically very helpful about how you could improve the value proposition, which is all really useful information rather than just trying to review it internally. So when we are looking at value proposition, there's a test that we do called the BUS test. And this explains what a value proposition needs to include. So first of all, you need to articulate the benefits and value to your clients of buying your service. If you can't articulate the real value and benefits, then it won't resonate with your prospects, and then they may not think that they need to use your services. Secondly, and I think this is an area that the marketing services industry in particular is one that could improve on, is the USP. If you don't have a USP and there's nothing particularly unique about what you do, then you're far more likely to be judged on price rather than on the value you can bring. Now, thriving agencies, they will be value-based selling. They will never be. They won't be worrying about the prices they pay, because the work that they're confident the work that they can do is so strategic and value adding that it won't become a conversation about price. I think one way that manifests itself in agency, when we're looking at agency websites in particular, is they're often quite generic, whereas the most profitable agencies and the most attractive ones to acquirers will be focusing on promoting their core proposition and be promoting themselves as experts, which of course moves those conversations away from price and more towards value. The third area, or the third element, which is really important, is your value proposition simple. If you can't simply articulate the features of it, then your prospective clients won't understand what you have to offer, and they may think they don't need it. Another way of thinking about that is, if we got 10 people from your business into a room and asked them to articulate what your value proposition is, how many times, how much discrepancy will there be between the answers? If people are very aligned, that suggests that your value proposition is very simple and clear. If you get 10 people and get 10 completely different answers, then it suggests that your value proposition isn't simple and understood by your internal organisation. So for potential clients, it's going to be really difficult, and that may suggest you have a poor value proposition. And finally, the final element that's important to build is trust. It's important to build trust through credentials, case studies, testimonials. So if a client hasn't worked with you before, then they have the confidence that you have the credentials and the ability to provide that service to them. Now, if you take any of these elements away, your value proposition will be lacking, and so your conversion rates probably won't be as high as they could be. So just in summary now, by understanding your target market and by having a value proposition that's compelling to your target market, you'll be putting in place the key building blocks to grow market share. Getting these two elements right will mean your marketing will be more efficient, conversion rates higher, which are both crucial in a lean market like the current time. So now just taking it back to the enterprise value slide that Mandy introduced earlier on. The business development is clearly a key area that drives business. And so if you can ensure that both your target market and value proposition are optimized, then this leads to increased efficiency of BD work, increased average utilization, your marketing costs will be lower, and that will simply should in theory cause profits to increase. Well, so secondly, if not more importantly, is the impact on multiple. If as a business you've got a really efficient BD process, you've got a value proposition that's compelling to the market, then it will be compelling to acquirers too. So you should become more sought after. So then your multiple should increase, and then you'll have the uplift in both profit and multiple, which is really a game changer when it comes to selling business. So 2020 may or may not be the year that you decide to sell, but that doesn't mean you can't still build shareholder value at the current time. Building value means improving profits, but also multiple, but also the final element is exit value, which is the combination of profitability and saleability. When times are difficult, making fast and effective improvements to BD can be the one thing that can help you survive at the current time, but also thrive as well, and come out of this stronger than ever. So I hope that's a useful introduction to some of the things you can be doing to increase market share and build enterprise value at the current time. I'm now going to hand over to Barry to provide the buyers and CEO's view.
Thank you very much, Paul. Good afternoon, everyone. Sadly, I haven't got any charts for you. Mandy said if I could just talk through, from my experience, what buyers are looking for. And I jotted down some notes. And my experience comes from doing M&A at Publicis and IPG for a number of years. Then, as Mandy said, for Creston PLC, which was on the main stock market and had been a property company, it was a cash shell, and we turned it into a Marcoms group, and it was very much an out-and-out buy and build, so on the public market. And now Strat7 Insight Analytics Consultancy with PE backing. And as I look back over that experience, I sort of got 5 themes or 5 buckets of what I generally look for when doing acquisitions and M&A. And I don't think they really change on whether it's a private equity-backed company or public company or a big group. I mean, obviously it can dial up or dial down, and obviously things change, pre, post-COVID, in an economic recession or not. But I think generally these are the themes anyway that I would look for. And those 5 buckets are, and I'll come back in more detail, is firstly the management team, their growth strategy, the strategic fit into the group or the buyer, the financials and operations of the company, and then the actual deal process. And sort of slightly surprised myself this, being an ex-accountant, and well, still an accountant, but looking at my first point was the chemistry and cultural fit of the management team into the rest of the organization. I think it's incredibly important to make sure that we have the correct fit. Otherwise, because at the end of the day, we need to, as the sort of buyer, need to make sure that all the individual companies within the group are working together. And if you haven't got that chemistry fit between the senior management team, then you're going to end up with an isolated agency operating as an island, which is the last thing you want, because you will never extract the sort of value and the opportunity from bringing that company within the group. There's certainly companies in the past that, I remember one company where we're actually about to sign the SPA in a week's time after about 3-4 months of due diligence, and a long conversation with the owner, and I just knew it wouldn't work, and we pulled out. So you've got to stick to, I think, one of my first criteria is the right chemistry and cultural fit. Also, the second tier management is incredibly important because, the founder, if they've got a very high majority of the shareholding, then obviously he or she is going to pocket a lot of money, and there's always a big risk of that individual leaving. So it really is really key and important how strong are the second tier management and what their vision and ambition is between that senior management team for how they're going to grow their company, and do they have a shared ambition for, in my case now, for Strat 7. You know, we launched last year, we're over 100 people, but we want to grow the company 5-fold over the next 5 years. And so I need ambitious senior team around me to achieve that vision. So are they sharing that ambition to grow us as a group, rather as well as their own individual companies? And along those lines, with the chemistry and cultural fit, there has to be a high level of trust between all the senior management team of the group. As you know, it takes a long time to build a client relationship. And if you're going to go after that sort of fabled client synergy, if I'm handing over my client to you to work on providing a different discipline, I need to make sure there's a high level of trust between ourselves, because I don't want that client relationship being screwed up by someone else within the group. So trust is really, really high. And still, and the sort of final point with the management team is, what are their motivations? If there's someone, if it's a retirement plan or someone just wants to sell to get the money and get out, then tell the buyer, be honest as you can be. The advisors will very often say, don't say any of that. Say you want to stick with the business for the rest of eternity, but everyone's motivations change. It's just, if we are going to grow the company over the next 10 years, and in order for the buyer to get the return on investment, the company has to keep growing beyond the earnout, then just be as honest as you can be about what your true motivations are for selling the company. So that first bucket is all around the management team. Second area is around the growth strategy of the company. I need to be able to see, what is the client strategy? How are they going to grow the existing clients? What are the account plans in place? If they're operating or got one brand of a Unilever, how are we going to get multiple other brands? So what is the strategy to develop those clients? And that ties into, what is the strategy for new clients as well? The business development, the sales and marketing, how mature is that process for the agency, or is it still very dependent upon the senior management and their personal relationships with the client? So what is the sort of the client and new client growth strategy? Another area, important area, is, what is the talent strategy? How is the company attracting new talent? How they're training them? How they retaining that talent as well, and how they're engaging with the talent. I think it was Mandy or Paul mentioned about doing, employee satisfaction surveys. That's a really important sort of part of the due diligence as well, for the buyer to see how engaged the talent is into the vision and the ambitions of that company. And also, what's the offer strategy? How is the company developing their product, their service? How is it being evolved? As we all know, you've got to adapt or die. Your competition is adapting the whole time. So how is the company, what is their growth strategy around their offer is really, really important as well. Then as part of that growth strategy, so if a company has got, I always see a hockey stick business plan from an acquisition target. So looking at the growth strategies, can I believe their 20%, 25% CAGR sort of growth business plan? Of course I don't, but I need to see some substantiation behind it. But then importantly for me is then, how can we actually help the company achieve and exceed their growth plan? What are we bringing to the table as the buyer and the rest of the group? Is it a sales and marketing team? Is it our developers that can help them on their product development? What is it? How can I exceed their business plan as a buyer? So what is their growth strategy in all those areas, clients, talent and offer? And then what is our growth strategy to help them exceed their targets? Third area is the strategic fit. If I'm looking at an acquisition target, what are they bringing to Strat 7? What is the discipline or the new capability or the new clients or the new sector? I'm a great believer, there's no, some groups are different. If they're a PR group, they want multiple PR agencies all competing against each other. From my perspectives, I want complementary agencies working together. They may have some overlap, but I think it's important that we have a complementary skill set. So again, what is the strategic fit of that acquisition target? Now, in the past, when I was in the big groups, to be frank, it was just a financial engineering earnings. They just want to buy earnings to drive the EPS, which will drive the share price, which will drive the LTIP. The LTIPs, long-term incentive plans of the senior management team. For smaller companies, that strategic fit is incredibly important because we've got to, going back to the second point around growth strategy. So how can Strat7 help that target company in exceeding their growth strategies? So what strategic gap is that company filling for us, the buyer? The fourth area is around sort of financials and operational. So, obviously really reviewing the financial performance of the company, what their growth has been from a revenue, a GP, EBIT, EBITDA basis, what their KPIs are, revenue per head, comp to revenue ratio, profit per head, all those areas. But then also breaking down what client dependency there is. Obviously, you want a very good client spread. What the different types of revenue are there? How much is retainer? How much is recurring? How much is license income? How much is really project based? So getting a good understanding of the types of revenue. Also in that financial review, there will be an element, right? What synergies are there that we can make? Is it cost of sales synergy? So if a company is doing data collection, can someone else within the Strat7 group provide those? So how can we recirculate more of the cost of sales within the group? And then also, what savings can we make from centralizing procurement of insurance or financial systems, etc. So what are the cost of sales synergies and what are the overhead synergies we can make in this? Because that will improve and accelerate our ROI. The other area in this is, as I've seen it so many times with smaller agencies, they wouldn't have had developed enough financial systems or HR systems, or they still need to invest in ISO 27001 or whatever it may be, or their sales and marketing team. So as the new owner of this business, what investment do we need to make back into their operational back end? And then part of the financials is also what is the return on investment for the buyer? So how many years will the payback be? Is it, and quite often sort of companies forget this. If it's a multiple of 6, if they stay still on a post-tax basis, it's going to take us as a buyer 8 years before we get 1 penny back, as an example. So how can we accelerate that return on investment from a number of years perspective? And what is the, whether it's accretive to EPS, earnings per share, if you're a public company, how accretive it is to the multiple if you're a PE-backed company. So we have different targets. And then also, what is this acquisition going to do from our leverage, our capital structure, and our balance sheet perspective? Again, that's internal for us. It's not the target company's issue, but it's something that is going to be really important for us, because I've seen it too many times. We have over-levered companies from doing too many acquisitions, and then they can't basically pay the earnouts. They're a public company, they have to issue a whole ton of shares, and then you're in a whole world of pain. If you're breaching banking covenants, that's a whole nother world of pain. So for the buyer, it's incredibly important to see, right, if I bring this company on, they max out on their earnout, which will be fantastic. What is my capital structure afterwards in my balance sheet? And then the last area is the deal process. How doable is this deal? Because at the end of the day, everyone's busy. We're all busy. Doing a deal is incredibly complex, especially when you're in a PE-backed vehicle. You've got to do financial due diligence, tax, legal. You've got to do all the SPA, the shareholder purchase agreements, all the legal side of it. You've got to do client due diligence. It's incredibly complex, time-consuming, and massively distracting to the management team as well. And if we've already, most deals you would sign an exclusivity agreement of say 3 months, I've got to do the deal within 3 months. So, and I'll have lots of other things on. My existing companies, they've got their own growth plans, so I've got to look after them as well. So I've got to make sure I can do this deal within the 3 month period. And that goes back to something I think Paul said about is everything in the right place? So that's the sort of fifth area. All those things will dial up or dial down, whether you're private equity or public or a large group or a consultancy. But I think it's, you know, how good are the management team? What are their ambitions? What are their growth strategies? What's the strategic fit into the buyer? What are their financial, operational performance? How can we improve that? And then just from a practical perspective, how quickly can we get this deal done? And is it a doable deal? Otherwise, walk away and move on to the next one that's going to help you grow your group. That's it. Very quick run through from hopefully what a buyer's looking for.
Barry, that's absolutely brilliant. Thank you very much indeed. Really interesting. Please post any questions in the Q&A function in the chat. Thank you very much to those who submitted questions in advance. The first one is for Barry. Why would buyers be looking now to make an acquisition in the current slightly odd circumstances in which we find ourselves?
Okay. I've heard a lot of people saying, oh, now is a great time to buy. You can get good deals, i.e. cheap deals. In my view, if a company's good, they know their value. So you're never going to, and if you get a cheap deal, it's like an iceberg. You know, typically what's underneath the waterline that you can't see, the crap that you got to sort out. So you'll always rather buy quality. And I think in this climate, we've got to have a very broad, innovative client offer. So if we bring a company on, back to this, the capability gap, is it bringing more to our servicing of clients? It will bring new clients into the group. It will give us greater scale. So I think that adds a lot to us during an economic downturn. And you can structure a deal maybe less upfront, but if the company performs, then all the money's, you know, the earn out is there. So you can usually structure a deal to meet the challenge between, it's a high risk time to buy a company, but also giving good and fair value to the vendors.
Okay, thank you. Question for Paul. What types of buyers are active at the moment, and what are they looking for?
So I think we're seeing quite an interesting mix of buyers, and I think one thing that has been quite refreshing since March actually is that a large number of buyers are still looking for acquisitions. The M&A report that we're about to publish, that you referred to at the start, Mandy, that is very much reflective, I think, of the types of buyers out there. I think there's the big networks, as you mentioned, they're not really buying anything in terms of conversations that we're having. There's very few, I'd expect to see very little activity continuing from the big groups. But private equity, there's a massive amount of interest, and that's proven by the data, but also in terms of the anecdotal conversations that we're having both directly with private equity funds. They got massive amounts of dry powder to deploy. Those companies are private equity backed, like Strat7, for instance, and various other private equity backed groups in the sector. We're having various conversations where they're always on the lookout for high quality businesses. There's quite a few independent agencies as well that maybe have come into this with strong balance sheets. I think the surveys that we did and that we have been running through this have shown that quite refreshingly a lot of agencies in the space have come into this with decent balance sheets, and those that have traded profitably are looking at how they can continue to build over the next few years. So there's a few independents as well. I think in terms of what specific things I think are businesses looking for, I think digital skill sets that was referred to at the start as being highly sought after. Businesses which can improve conversion rates and can trade in a remote environment clearly will have been doing very well and will continue to be sought after by acquirers. Programmatic and performance seems to be another trend. But I think the point that Barry made in terms of businesses which have got a strong proposition and are confident about their value. I'd expect that in my view, there's definitely acquirers out there who will look at things despite the general economic malaise at the moment. More broadly still, there are a lot of businesses who are looking for on a more opportunistic basis, and even if you're in an agency that's supposedly struggling at the moment, there's still definitely acquirers out there who will be able to provide a safe home to both the team and will be looking for clients. So I think there's definitely a lot of options out there for various different segments and sectors.
Thank you, Paul. Barry, another question for you. You talked about chemistry being one of the things that derailed a deal, and you talked as well towards the end about deals feeling doable. What are the things? What are your red flags?
When it takes a week for someone to come back to you on a piece of information. I'm in the middle of a transaction at the moment, and it's a delight working with the team there, because you ask a question and it comes back quickly, well thought through, informative, and I think it's that sort of speed of proactivity, because then you get a feel for how your working relationship is going to be post deal. So I think that's usually quite a big sign. Now, we've definitely worked with companies that have very poor financial systems, and it does take longer. But if people are open about that, that's fine. We can help putting the right financial systems in place. Again, I think it's coming back to that honesty and trust element.
Yeah, thank you. And we've got a question, I think, actually, Paul, this is for you and I. If an agency divests itself of an underperforming division or practice that's now seen as non-core or peripheral, is the sale process broadly the same, or are there significant differences?
So I think that depends slightly. I think it depends on the size of that division and how quickly the agency wants to divest itself of that particular asset. It's quite possible to run a quick process with maybe a few very, very targeted acquirers, and so that can be done in a relatively short manner. Although from an acquirer's perspective, they'll still want to make sure they meet the team, they assess the chemistry. But in terms of whilst on a full sale process, you might want to make sure you're speaking to a large segment of or a decent number of buyers to try and find the best home for it. If you've maybe pre-qualified a few and you can have a few targeted discussions, then you can do it. You can do that a lot quicker. One thing I think it depends as well on the seller. I think one particular sale that we worked on recently from one of the big networks, that took an awful long time because of the complexities of both structuring the transaction from a financial perspective, but then also unpicking it from the workings of the big group and managing the internal stakeholder relationships within the network. So it really does vary. But from an acquirer's perspective, I'd imagine that they'd want to take the same amount of time to assess it as they would from any other acquisition.
Brilliant, Paul. Thank you very much. I think that brings us to the close of our timescale here. I'd just like to thank Barry so much for coming along and talking to us. That was really interesting. Paul, thank you very much. And we will share slides and a link to a recording and the Q&A. And thank you very much to everybody out there for joining us. We will also send around a poll asking how you found the seminar and asking for feedback. And as ever, it's tremendously helpful to us if you can just take a minute to fill that in. Thank you very much. Bye-bye.
Thank you very much. Bye-bye.
Bye.
Thanks.